Hey, what's going on, everyone? Christian Carter. One of the most popular questions that was Googled in 2022 when it comes to buying a home is what is the best type of mortgage for me? And that is a very, very difficult question to answer. However, we're going to try and answer it today. Now, as you'll see behind me, there's a ton of stuff going on. Don't worry, don't get intimidated. We're going to go through it and we're going to attempt to answer this question by addressing four topics, right? We're going to talk about occupancy type, then we're going to talk about interest rate options, loan term options, and then finally, after we've talked about all three of those subjects, we're going to try and figure out a mortgage program, or we're going to go over the highlights of each mortgage program to try and answer the question, what is the best mortgage for me? So buckle up, it's going to be a good video. All right, occupancy types. When it comes to the mortgage industry, there are three types of occupancy that we go by, right? And that's primary residence, that's second home, and that's investment property, all right? Primary residence, just like it sounds, you intend for this to be your primary residence where you're going to live a vast majority of the time. Primary residence, from our perspective, from the lender's perspective, that is seen as the lowest risk, right? So those primary residence loans, those will come with the lower interest rate, lower down payment, and things like that. All right. Second home, again, just like it sounds. Some people do call this a vacation home or a vacation property. Same thing. A second home is going to be where you will reside a little bit, but not for the vast majority of the year, right? So it's just going to be a place that you vacation and things like that. Down payment's going to be a little bit higher, right? So for a second home, we're looking for like a 10% down payment. And then the interest rate's going to be slightly higher, usually 1/4% higher than your normal primary residence loans. And then lastly, for occupancy type, we've got investment property. Again, just like it sounds, you're not going to occupy this property at all as your primary residence. It's going to be a strictly investment property where you're looking to collect rent and things like that. Investment property, definitely the riskiest from our perspective. So with risk comes higher interest rate and higher down payment. All right, now let's go over to interest rate options. I covered, again, three of them right here. We've got a fixed rate, we've got an adjustable rate, and then we've got interest only, okay? So for interest rate options, we'll start off with the fixed rate. If you ever see FRM, the acronym, that just stands for fixed rate mortgage. So this is good because a fixed rate is constant throughout the term, right? So the rate is not going to fluctuate up or down during that mortgage. It is going to stay at the exact same rate. Now, what a fixed rate does is it offers you stability and predictable monthly payments, meaning your monthly principal and interest payment is not going to shoot up or shoot down throughout that loan term, right? So it's nice, predictable monthly payments. I would say fixed rate mortgage, definitely the most popular option, especially a couple of years ago when rates were so low. Everyone was locking in at a fixed rate mortgage. So hope that answers the fixed rate mortgage question. Now, adjustable rate mortgage, right? Just like it sounds, this is a rate that can fluctuate periodically based on market conditions. Now, these adjustable rate mortgages, they typically have a floor and a ceiling, right? So a ceiling meaning that the interest rate can adjust, but it can't go above a certain ceiling or a certain interest rate number, right? Let's say 8%. Now, at the same time, they have a floor, right? So that at the same time, that interest rate may adjust, may fluctuate with the market, but it can't go below the floor of, let's say, 5%, right? So typically have a floor and a ceiling. All right, so adjustable rate mortgages are great for short-term mortgages. And what I mean by that is, let's say you are buying a home and you're going to be moving in 4 years, right? You absolutely know you're moving in 4 years. Well, an ARM or an adjustable rate mortgage would be a great option to do like a 5 or a 7 year ARM, right? Because with adjustable rate mortgages, you'll get a lower initial interest rate. And then after that first period, that first 5 or 7 or 10 year period, that's when the rate starts to fluctuate and adjust, right? So if you know that you're only going to be living in this home for 4 years, then why not do it? And you're going to sell it, or something like that. Then why not do an adjustable rate? You'll probably save some money. Now, when you see the term or the acronym ARM, that's going to mean adjustable rate mortgage. So ARMs get thrown around a lot in the mortgage industry. ARMs just mean adjustable rate mortgage, ARM. All right, last up here, we have interest only. Again, if you see the acronym IO, that's going to be referring to interest only. With interest only, just like it sounds, you only pay interest for a specified period of time, right? Now, that time period could be 5 years, could be 10 years, but typically when we structure an interest-only loan, we're going to say, okay, we have interest-only payments for the first 5 years or the first 10 years, right? However, after that initial period, the loan is going to either turn into a fully amortizing loan, meaning after that 5 or 10 year period, now you have to start making principal and interest payments to fully amortize or fully pay back the loan. Or sometimes after that initial 5 to 10 interest-only period, you might get a balloon payment, right? And we're not going to go into it here, but a balloon payment essentially says that, at the end of that 5 to 10 year term, you owe us all our money back. So you either need to, take assets out of another account, you need to sell the home, things like that. So when we're looking at interest only is really great in the respect that your monthly payments are going to be really, really low. Now, the bad side of an interest only payment is that it's not fully amortizing, right? And what we mean by that is that you're not paying the loan back, you're only paying the interest, right? So eventually, like we said, after that 5-10 year period, you're gonna have to figure out what to do with your interest only mortgage. So interest only, kind of like an ARM or an adjustable rate, it's good for a short period of time. All right, so next on the list is loan term options. And the loan term is basically how long the loan is going to be, right? And then two really popular options that everyone hears about is the 15-year and the 30-year, right? So for example, if you do a 15-year mortgage, there's going to be a fast pay down, right? So you're going to pay your mortgage off in 15 years as opposed to 30 years, which is much faster. However, with that fast pay down, you're going to get a lower rate, which is always good. However, your monthly payment is going to be much, much higher on a 15-year than it would be on, let's say, a 30-year. And with that higher monthly payment with a 15-year, it's going to be tougher to qualify for because your debt to income ratio is going to be higher at a 15-year than it is for a 30-year, right? So 15-year mortgages are great. They're definitely your monthly payment is definitely gonna be higher than, let's say, a 30-year. And then of course, a 30-year, definitely the most popular. I would say, just combining, if we want to combine the first three topics we've talked about so far, probably the most common is a primary residence fixed rate mortgage for 30 years, right? That's what we see the most of. But there are other loan term options as well. A couple lenders have come out. I know we have one with a 40-year mortgage term, which is really long. That means your payments are even less than your typical 30-year. However, you can also do a mortgage for 5, 10, 7 years or anything like that. And just one more quick thing to note when it comes to loan term options, it's actually done by the month. So you can have a really kind of so when we talk about a 30-year mortgage, it's really a 360-month mortgage. So you can essentially have a mortgage for as many or as little months as you want, as long as you're within a certain window, right? So it really comes down to the number of months. All right, last on the list here, stick with me. Mortgage programs. So there's a number of mortgage programs that you can see lined up over here. Each one of these programs probably needs its own 10-minute video just to talk about the highlights and everything like that. However, I'm going to go real quick through this list and try and give you guys the meat and potatoes on each mortgage program. So first up on the list, we have government-backed mortgages, right? Now, when you hear government-backed mortgages, think about FHA, VA, and USDA, right? So those three mortgage programs are very, very common. They allow for really low down payment options. FHA mortgage only requires a 3.5% down payment, which is really low. And then, of course, VA and USDA, that's no down payment whatsoever. So you do not have to make a down payment with VA or USDA. Now, with these government-backed mortgages, you're also going to find much more flexible credit requirements. So they're a little bit more flexible when it comes to lower credit scores. When it comes to debt to income ratios, you're typically a little higher. So these government-backed mortgages, they're very, very good with a lot of things. However, they do come with their own mortgage insurance. They each call it something else, but their mortgage insurance can be rather expensive. All right, so next up here on the list is a conventional mortgage, right? So when we're thinking conventional mortgage, we're thinking not necessarily government, but we're thinking Fannie Mae and Freddie Mac, right? So these conventional mortgages are basically your cookie cutter standard mortgage that's going to meet the requirements or criteria set forth by Fannie Mae and or Freddie Mac, right? Again, I don't want to get into the weeds with this, but essentially what this allows lenders like us to do is to give someone a mortgage based off Fannie Mae's criteria, right, or their requirements. And then once the loan is closed, once we take that mortgage and we sell it to Fannie Mae or Freddie Mac in order to create more liquidity so we can help the next person buy their home. So when we're thinking about conventional mortgages, we're thinking real cookie cutter. We're thinking we can do it for a primary residence, second home, investment property, but you're looking at fairly more stringent underwriting standards. So your credit score is going to have to be good. Your debt to income ratio can't be sky high or anything like that. So that's essentially conventional mortgages. All right, next on the list, first-time home buyers. This is another huge question that we get all the time. When we're thinking about a first-time home buyer mortgage, kind of think that it's a government initiative to encourage home ownership, right? So in the way they do that is essentially they offer really low down payments. Again, sometimes your typical down payment with a first-time home buyer program is 3%. However, a lot of times there are grants out there that will help you cover that 3% down payment. So with some of these first-time home buyer programs, you could really be looking at a 0% down payment, which is awesome. Now, also with these first-time home buyer programs, it generally comes with reduced private mortgage insurance, which is awesome. But another thing to look out for is there are income limits with a lot of these first-time home buyer programs. So if you make a certain amount of money, even though you don't own a home yet and you're looking to buy a home, if you earn a certain amount of money, it might knock you out from the first-time home buyer program. So just something to think of, something to be aware of. All right, next on the list, jumbo mortgage. So a jumbo mortgage is any loan or mortgage where the loan amount is higher than the conforming loan limit. So basically, we're in 2023 right now. So the baseline for a single family home in the United States, the loan amount is $726,200, right? So anything above that $726,200 single family home, that's going to be considered a jumbo mortgage, right? Now, huge thing to look out for is that jumbo mortgages, this baseline this loan amount, what makes it a jumbo mortgage is going to vary county by county. So if you look at places like Martha's Vineyard, Alaska, Hawaii, the loan amount that you're looking at is going to be much, much higher for a jumbo mortgages because homes out there are so expensive. I don't know off the top of my head, but I think, Alaska, Hawaii, Martha's Vineyard, instead of a baseline or a loan amount of 726 to make it a jumbo loan, it's definitely closer to $1 million. So why do we care about jumbo loans? Jumbo loans kind of puts you in like a different category. And again, underwriters are going to be a lot more strict when it comes to credit score, down payment, debt to income ratio, and things like that. So it's just good to know what the conforming loan limit is in your county. So if you would like, so you can stay under that jumbo mortgage loan limit. All right, enough about jumbo mortgages. We've got a renovation mortgage or a construction mortgage. So essentially, these are really, really great. A renovation mortgage is where you're buying an already existing property and it needs some tender love and care, some TLC. So essentially what you do is you borrow the funds to fix up that property, right? So that's like a renovation mortgage. And then a construction mortgage would essentially be along the terms of you're buying a plot of land and then you are building a house from the ground up. So that's more construction. All right, next here, maybe a reverse mortgage is right for you. So reverse mortgages, you've got to be 62 years of age or older. And kind of the cool thing about reverse mortgages is that you get to tap into the equity in your home. And the repayment terms with these reverse mortgages are very, very flexible. So a lot of times you get to draw on that equity, the cash in your home, and you don't need to repay that mortgage or repay that loan until the house is sold or, heaven forbid, you die. So, all right, next on the list here is cash out refinance or HELOC. Of course, HELOC stands for Home Equity Line of Credit. Now, these two options, they're going to be more geared towards if you already own a home, right? So a cash out refinance is essentially you are refinancing your current mortgage to tap into some of the cash or the equity within your home, right? So essentially, if your home's worth $100,000, you have a $50,000 mortgage, you can do a cash out refinance. So basically, bump your loan amount from $50,000 up to $75,000. Take that $25,000 in cash and go, do whatever you want with it. And then a HELOC, home equity line of credit, that's almost like it's the same thing as far as tapping into the equity within your home, but it's having a line of credit, right? So it's almost like having almost like a checking account or something like that tied to your home. But again, those two options, they're going to be more along the lines of if you already own a home. All right, these next two, commercial mortgage and then DSCR, these apply more to an investment property than a primary residence or second home. So commercial mortgages, definitely going to be an investment property or something along the lines for like business purposes, right? So if you are looking to, buy an apartment building, buy a storage center, buy an ice cream shop, gas station, things like that, then you're probably going to have to go down the commercial mortgage route. And the thing with commercial mortgages is that there's no real cookie cutter kind of criteria like we have with our conventional mortgages, Fannie Mae, Freddie Mac. But you are definitely, with commercial mortgages, you're going to be looking at a higher down payment, probably 25% at least. Going to be looking at a higher interest rate. It's probably not going to be a fixed interest rate, probably going to be along the lines of adjustable. And with the loan term options, probably not looking at a 30-year. It's probably going to be a lot smaller than that. So that's the commercial mortgage aspect. Think of commercial mortgage, investment property, business purposes, things along that line. Definitely not a primary residence. All right, last one here, DSCR. And that, of course, stands for Debt Service Coverage Ratio. And that's really tough to say. DSCR loans, they're definitely going to be more geared towards investment properties like we talked about. And essentially, when you're looking at a DSCR loan, think about DSCR just like you would think about DTI, right? Or debt to income ratio. So essentially, when it comes to a DSCR, we're going to be looking at the net operating income, right? So how much income that property, that investment property brings in, and then we're going to be looking at your debt service, right? So the principal and the interest of paying back the loan, kind of just like a debt to income ratio, where a debt to income ratio looks at a borrower's personal income, all the income they have coming in, and then compares it with all the debt that they have as well. Same thing with a DSCR. We're going to be looking at the NOI, net operating income of that, let's say, apartment building, and then we'll compare that net operating income with the debt service of that apartment building. So we'll compare it with the loan, the principal interest loan to pay back that apartment building. Hope that made sense. But again, these two, DSCR and commercial, definitely looking more at investment properties, so not like your primary residence or anything like that. So, like we said, very, very difficult question to answer, right? What mortgage is best for me? Well, it all depends. And it depends on these four different categories, right? What your interest rate options are, what kind of loan term you're looking for. This one's very important, the occupancy type. And then once we figure out those three, we can figure out what kind of mortgage program would be best. So I hope you like this video. More questions, please keep them coming. I love making these. And any questions, as always, reach out to me anytime. Have a good one.